Yeah, we are ready for this session, and there are people around with mics, so please, all yours.
Yeah, hi. This is Chirag Shah from CLSA. First of all, thank you very much for hosting us over this. It's been a first for many of us in the last couple of years. It's good to interact with you guys in person. Since I have the entire team of Titan here, what I wanted to ask you was, have we deliberated around how we intend to allocate capital over the next 5 years, right? So Ashok made this point around how cash flows cumulatively over the last 5 years have been more than $1 billion plus cash profit. And if I look at the growth plans going ahead, obviously the cash profit is going to be much bigger than what we have done in the last 5 years. A lot of the businesses, in particularly jewelry, for example, is now in a self-sustaining mode. You don't really require too much of capital because a bulk of it is now through the franchisee route, and a lot of the working capital requirement is met through the gold lease program. So if I have to think about the next 5 years as to how will Titan allocate the capital, how much of it would go into new businesses, what would be the criteria around how do we allocate this capital for some of these new businesses, what are the capital requirements for the existing businesses, and so on and so forth. Just your thoughts on that.
Okay, so just one point I thought I'll tell you, that while you are right, jewelry is on self-sustaining, but it is not that it will give too much cash out of its growth plan. So we have three kind of franchisee model, three kind of boutique. One is which is completely company owned. The second one is kind of completely franchisee owned, but there is an in-between model also, where, like they have the management of the store and everything, but inventory belongs to us. And many places that choice is made by the business where they want to kind of go for L2 or L3. And there are several considerations. I will not go into detail, but almost equally that kind of rollout happens every year. And that requires inventory input and inventory investment from our side. So you are right, jewelry has a self-sufficient cash generation capacity, and that is where I mentioned 15 to 20% growth organically. With all the businesses, we really don't need to go out of cash. Considering that also, if you would have noticed, we kind of increased our dividend bar this time, that we thought that is important to at least, while our policy suggests 25 to 40%, but at least to be around 30%, 1/3 of the profit should go back to shareholders. So that is one part. The other part of things, so this cash is good for our businesses which are right now already in play. While Venkat can say, but what our internal thinking is that next 2-3 years, we are not going to enter into a new category. Rather, we will focus on doing fashion and fragrances and Taneira and international, everything. You would have also noticed that even the mature businesses like watches is completely reimagining its retail footprint, and which also requires investment from our side. So I think it is bringing all these things out through our own generation. If we have to do some significant strategic investment, no doubt we will have to go out and borrow. But fortunately, our balance sheet is in a very, very healthy stage. So if we decide to do that, which is right now nothing is on the card, we believe we will have ability to do that. So that is how I think you should think about our capital allocation. The new businesses are going to get, as I told you, upfront lot of support from our side.
So in that context, eyewear business, which can be in a hyper growth mode, what kind of capital investments can we look at investing in the eyewear business in particular? And since you also mentioned that you're unlikely to get into new categories in the next 2-3 years, so eyewear clearly looks like a lot of the capital could be allocated to that segment. Is that understanding right?
Actually, from an overall business model point of view, eye care does not really require that much of capital, because it is a franchisee model, and today it is also wholesale, because we are getting more and more into the distribution side. So the large opportunity, including what Shaman spoke of, which is those millions of people, in fact, crores of people who need a correction, but not even aware that they need correction. So a fair amount of investments, I feel is more in OpEx, market building, customer acquisition, and not, so much on CapEx. So that's on the eye care. And just adding a little more to what Ashok said, we felt that we've been into some new businesses for many years without acquiring respectable scale. And that's the background to multiple X on bags, multiple X on Taneira International. International will require CapEx. Taneira is a franchise model, so not so much of CapEx. Bags is more a wholesale model, little bit of retail. So again, not so much of CapEx that we see. Whereas jewelry is intrinsically, we're pursuing L2 even outside India, but partly self-financed through gold on lease. And we also, from a return on time invested point of view, we want to focus on what we have, the portfolio that we have today, and not even touch anything new for the next 2 years, so that the management time is maximized into these current new businesses, and only in maybe calendar 24 start thinking about anything else new. Because like I said, India is one country, but many economies from a scale point of view. And the jewelry business, in fact, on a last call in a media interaction, I spoke of the next 2-3 decades. When that question was about the last 3 months, I spoke about the next 3 decades, particularly from a jewelry point of view. And that's how long that runway is.
Hi, sir. This is Percy Panthaki from IIFL. My question is for Ajay. So in one of the charts where you had color-coded sort of progress, what is going to drag down the growth and which are the segments which are going to go ahead of the company, there was one of the line items in yellow which says, I think, growing the core, and there you had written volume thrust or something like that. Can you elaborate on that, please?
Yeah, I'd like to first clarify that the yellow was not dragging down, it is at the average level.
Sure.
The green is leading the average and red would be below. So on core, it's currently contributing 43% of the business. It is expected to sustain that 43%. Whereas on wedding, for example, if it's contributing 20%, we expect that contribution to keep going up. Yeah, that's the way to read that particular channel. And therefore, there were 3 growth engines which were put in yellow, which is at the average level. One was core, the other was golden harvest, and the third was exchange. Now, of course, if we innovate on any of these, for example, exchange, and we are experimenting many things, it could go into the green as well. But at least it is going to expect it to remain at that level as what it is currently contributing.
And when you say core is 43%, is this basically your plain gold jewelry, ex-wedding jewelry? Is that how it is defined?
A large part of it, yes, but it also includes some amount of the studded at the sub 1 lakh level. There's a lot of regular, what we call them as everyday specials, which are sitting at below 50,000 and below 75,000, below 1 lakh, where we sell a lot of volume. So it's a combination of gold and studded, but a lot more gold.
Right. And when you had written volume thrust against that, what exactly do you mean by that? Can you elaborate, please?
Yeah. So volume thrust essentially implies number of buyers, because that's the funnel that we work with. People who come into the brand, most people who come into the brand typically come in at that sub 50,000, sub 1 lakh, sub 25,000. They may start off with a ring or an earring or a chain, but it's over 3 to 4 years of buying from us. And if we are able to ensure that they continue to buy from us, then they start moving into the 1 lakh plus and 2 lakh plus segment. So number of buyers that we serve actually is what that represents, that volume thrust, not grammage as much. Grammage, of course, could go up or up or down based on how gold prices behave. So we look at volumes as buyers. And I think we had that conversation even, on one of the interactions that we had.
Sure, sure. Next question, Ajay, is that this market share which you showed at 6%, I mean, that's on a denominator of the total jewelry market, right? Now, a very large part of the market, the total jewelry market is very, very price sensitive, as in they will not even pay 3 or 4% extra as the overall value of the gold, I mean, value of the bill. And therefore, a large part of that market actually will not fall within your target market. I mean, there is a price sensitive customer who is a very meaningful part of the overall market in terms of numbers, to whom the tighten pricing will probably not appeal. So what really do you consider your market share currently, within what you would put in the denominator as a possible addressable market and not the total jewelry market of India?
So if you're asking for a precise number, it's going to be very difficult. So I'll give you why I'm saying this. You can look at the organized share and say, yes, organized share is 30% and that's going up to 40, 50%. That could be one way to look at addressable. Another way to look at it is specific players whom we consider as whose customers and our customers are common. Now, typically, if I look at Chennai or TN, we may say that the customers of, let's say, a player like GRT or a Thangamalige, etc., may be very different from us. But is it right to say that those customers don't buy from us or they don't buy from both? Very difficult. If I go to a small town, there may be a player who's actually a 200 crore player, and we may be today a 30, 40, or even a 50 crore player. If we grow, we typically see that customers from those players also come back to us. Price sensitivity is dependent on two things. One is on gold rate and the other is on making charge. With gold rates, in a way, the secular trend towards gold rate is a certain normalization that is likely to happen over a period of time, thanks to hallmarking. And also several efforts that the government is doing to try and bring about a certain organized play in gold, whether it is through Gift City, whether it's through the gold exchange, etc., that is being proposed. So if you look at it for the next 3, 4, 5 years, the markup on gold that Tanishq would be enjoying may not be there. And in fact, we have been moving that towards making charges. Now, making charges itself, again, it's a dispersion. If I go down, there are KVIs which will be operating at 8%, 9%, 10% market making charge. And then there are products where you can go up to 21, 22, 23. So we can be competitive at the KVI, let's say at a chain level, etc., and still try and gain share. And thereafter migrate the customer towards, let's say, higher margin products. So when you ask for addressable market, and we have looked at it many a times in the past on addressable market and said, yes, we feel happy we are at 10% or 15%. We have realized actually the total market is the best way to look at it, because eventually a large number of customers are also migrating from family jewelers to more trusted players. In fact, a recent research that we did, a pretty large sample size research of all the new customers who came in, more than 60% of them actually said that they preferred to come to us because they no longer want to shop from their family jeweler on account of trust. So defining addressable market becomes a little challenging.
Just a couple of data points. This morning, I got a message from our franchisee in Baleshwar. Baleshwar is a town in Odisha. And he sent me an invitation for an eye care store that is opening in Dhenkanal, which is another town in Odisha. Then I messaged him, look, what did you close last year in Baleshwar? I had been there 7 months back. 60 crores is the sale of Tanishq, was the sale of Tanishq in Baleshwar in FY22. And I suspect it's more than 50% market share in Baleshwar. So this 6% all India market share that Ajoy was sharing in the 400,000 crore is actually 50%, more than 50% in Baleshwar. And another town called Angul, also in Odisha, I think it's more than 50%. We have 50 crores in Angul. So the transformation that is happening in all kinds of places where the making charge may be 4%, but the cumulative caratage of the sale is maybe 18 carats. So what the customers thought was 22, they're actually, being given 18 or 17 carat by jewelers, which is getting exposed when we buy that gold for exchange in our stores in those towns. And the customers are realizing overall value because each carat difference is 4%. So 18 carat is 16% difference plus 4% making charge is actually 20%, which is as good as buying Tanishq.
Right. So last question from my side is, you mentioned the 5-year target of 2.5 times in jewelry. So that works out to a CAGR of about 20% over a 5-year period. Do you think that the near-term growth could be higher than that because we are coming out of a COVID disruption, et cetera, or do you believe it will be pretty sort of smoothly spread out that 20% over 5 years?
So we hope so. That the near term is better than the average. And we believe we are chasing that.
Right, so
You're
that's
right.
all.
Quarter one was a disrupted quarter last 2 years. So obviously in quarter one, if you bump it up significantly, your estimate is right.
Yeah, I was not talking about only Q1, but rather FY23 as a whole.
Overall, because of quarter one, it will skew it and therefore the overall can certainly be much better than 20.
Right, sir. That's all from me. Thanks and all the best.
Hi, this is Amit Sachdeva from HSBC for the next question, please. So I have a question first on Taneira and then on Tanishq. On Taneira, I noticed that, from 23 stores, we are targeting about 125 stores in 5 years to the revenue of about 1,000 crores. And if I were to and for 1.5 million pieces, if I read that correctly, which essentially works out that you want to add about 20 stores a year for next 5 years, and maybe roughly per piece, SKU targeting is about 7,000 rupees, roughly. That's the kind of average numbers that I could make out, which makes me wonder whether the expansion target of 20 stores, is it ambitious at all? Because we are coming from COVID, this whole thing was delayed, and we're just adding 20 stores a year. Can it be a little bit more, or this is just a very conservative number? And second is basically if 7,000 rupees is the SKU thing, are you just looking at the saris or some other SKUs development will happen around that? And if you could be very kind enough to also tell me with whether it's franchisee and whether L2 and L3 is there a same structure, how we should think about the business plan for Taneira for next 5 years if 1,000 crore was to be achieved. That's question number one.
Yeah, thanks, Amit. Certainly, the opportunity in that market is, much bigger than what that 1,000 crore perhaps suggests. And the network expansion target for FY23 is actually rather more ambitious than what that 20 per year suggests. So I think, we want to actually execute FY23, and maybe when we meet here again, next year, same time, it could be different. So that's the first point on the size of the opportunity in the ethnic wear space, and whether this ambition is it's actually multiple X. FY23 is multiple X of FY22 and even FY20. And we want to do that before we leap even further. That's point number one. The second is like what Ashok spoke in his presentation. Sometimes we end up over-focusing in the early stages of a business on gross margin as well as profitability, and in a way, not capitalize enough on the sales opportunity and a long-term growth that actually is possible, both on margin as well as, gross margin as well as. So, in a way, making sure that the customer value proposition is right by doing the right price points and delivering exceptional customer value. And therefore that 7,500 rupees that you ended up calculating in a way mirrors that thinking about sales, customer acquisition, sales, gross margin, profit in that order of journey. And therefore that 7,500 reflects that. It reflects the manner in which we will play price points as well as price premiums, and therefore, a little more conservative on that, target rather than going after the higher ticket sizes, higher margins and all that. And I think we will be in a much better position to, be very ambitious on those two aspects 1 year down the road. This year, the focus is a huge expansion in terms of network, making every franchisee, every store really exceptional in terms of both customer value proposition as well as the franchisee delight. Coming to the last aspect of your question, it is from now on, we are talking about 100 more stores nearly in that journey. I think about 90 plus are franchise and L3. It's a buy and sell. We are, I'm sorry, L2. We are looking at experimenting in a big way with L3 during FY23 and then deciding on whether thereafter it should be a, L3 or L2.
So Venkat, thank you so much for this. Would it be also prêt-à-porter like ready to wear or just the saris?
From today's share of, I think we are at 93% or something on saris. FY26, we are looking at maybe 75%. So a decent share of what we call salwar kameez dupatta SKD, which is, ready to wear in some sense. A little bit of lehengas, but still 75% saris at that time.
Got it. Thanks so much, Venkat. My second question quickly on jewelry is that I remember in 2018 when we did that big plan and we had a 5-year target. That time, I think we had mentioned that exchange is the core value proposition in that journey. And we would be probably doing 50% exchange as a part of gold exchange, because wedding is the focus and high ticket value is the focus. Now I see from your chart, Ajoy, is that wedding is part of the high growth area, but exchange is part of the average. And we're already at 40%. Is this exchange margin dilutive that you want to underplay it down, or is there some different thinking working in balancing margin and growth, etc.? Especially exchange and wedding linkage, I'm sort of trying to see a disconnect there when it can grow exponentially. Why exchange is being lower? And in the context of it, if you can answer also competition, you mentioned price wars and heightened competition. What do you mean by that? And what sort of price war you're seeing in what particular segment and how you get impacted by it? That's on jewelry, please.
Yeah, thanks, Amit. So exchange in the last 2 years has actually tapered down a bit. And that is why we've kept it at moderate, that is at the average. You're right, there is a correlation between exchange and wedding, and we've tried to play that up. And even as we speak, the current campaign that is going up is going to play upon exchange parallel to whatever is happening on Riva. Having said that, because of gold price movement, a lot of customers have chosen not to exchange. Now, that's a customer prerogative, and it's something that we can't control, though we will continue to drive. So it's an important part. It still contributes around 41-42% of our, as a contribution, sales through exchange does contribute, and out of which about 33 is non-Tanishq gold, and the balance is Tanishq gold. So TEP is stable. It is the GEP, which is the non-Tanishq gold, which fluctuates based on customer sentiment towards gold and what he or she expects. We are not trying to downplay it from a margin perspective. No. In fact, we have gone ahead in markets and tried to align our policies which make it as competitive as it is required in the many India spirit that I spoke about. So, and we have a few strategic, let's say, messages around that, like, unlocking your locker jewelry, etc., which are there in our thought pipeline, but we are still trying to see how to unlock it in a much bigger way. So therefore, we have not said it will lead, but it will sustain. Wedding, on the other hand, is not dependent entirely on exchange. In fact, there's a lot of wedding sale that happens beyond exchange, and we think that can grow really well. And as India gets more affluent, etc., I think, I talked about even the formalization, the PAN card comes out more easily if we are able to excite with relevant designs and, desire building. What was your second part of the question that you asked? Competition, yes. So we are seeing in the last about 15 months now, we've been seeing a lot of competition on the gold rate itself. And one player, of course, brought it out by saying One India, One Gold rate, etc. But having said that, it is not that One India rate which has mattered as much as the fact that are you offering the lowest gold rate in that market and how much you want to dial it up. Now, many of the local players are also responding to that in a certain manner because they want to hold on to their customers. And many of the other organized players have also responded because they saw sometimes a defensive strategy, sometimes an offensive strategy. So in different parts of the market, we saw different responses to that. And therefore, gold rate related competitive intensities there. We ourselves have also responded in different markets in different ways. And we have recognized that it's better not to argue too much with the customer on gold rate. Once she's in, it's our design, it's our customer experience, it's our product depth, merchandise, it's our freshness. That's what matters. And really, then the discussion goes in a different. The second piece that we've been doing is because our exchange policy is also most attractive, we've been dialing that up in many markets. So intensity on competition, AMC fight or whatever, discounts and offers are always there. In the last 18 months or 15 months, we are seeing a lot more action on the gold rate. On the per gram, I'm giving you 100 rupees off or 200 rupees off or 300. That's become part of the vocabulary. And of course, this will continue and we are not worried about it. We just have to ensure that we are competitive and we are able to delight the customer with what we are good at.
Hello. This is Gautami Desai from Chanakya Capital. Sir, actually, I don't have any numbers from your annual report where I can actually calculate the gross margin of the jewelry division, and I'm not even looking at those numbers. You used to provide them earlier, but now you don't. So that's fine. But so when I do my sheets, it is a very clear observation to me that unless your gross margins in jewelry division has gone up, it wouldn't have been possible to get the kind of margins that we have got. So, and of course, I know that, in gold, there is no economy of scale, like, 1 gram or 1 kilo, you have to source is the same price. So is my observation right that the gross margin in the jewelry section has gone up? And it's not because of studded, because your proportion has not gone up. So, and I've been grappling with these questions for the past 2-3 quarters. So can you help me with this? I mean, is the observation at all right? And if it is right, then how did you manage it?
So gross margins have sustained actually, to give you a broad sense. It's operating leverage which has kicked in and given us the EBIT margin improvement. And gross margins have sustained despite, the interplay between studded and gold, and within gold, the profitable parts and the more commodity side part. So there is a mix related piece. There are many gives and takes. If I were to quote my commercial head, he keeps using those words. There are many gives and takes every quarter, every month on what happens on that margin. But by and large, we've tried to ensure that there is stability in gross margin across the plain gold side as well as across the studded side. On the studded, we've had some gains in the recent past. But overall, I would say you can go with the view that gross margins have been stable, and our attempt will be to try and keep them stable, but we are not trying to manage the gross margin as much as the overall EBIT margin so that the business keeps growing.
So
Operating leverage is the main thing which has worked, if you ask me, last year.
So apart from the studded percentage going up, that's fine, that's understandable. Other than that, what are the levers that, could possibly increase the gross margin if we really do 2x, 3x? Is there any lever, any such lever out there?
So the levers are really product mix, whether it is studded or even in the gold. Let's say when we talk about wedding, typically there is a lot more of value addition that goes in and the kind of products that we sell are of that particular type. And similarly, if you look at plain jewelry with stones, or we look at, color stones, etc., or you look at polki, and you look at these different kinds of product mix is the biggest lever. And therefore, the directional approach is to be able to migrate more margin towards making charges through a product mix management. And the other area which impacts gross margin, which is a lever, but we have not chosen to play upon it because it's actually works the other way, is to do with geographic mix. So we have different kind of product mix and different gold rate markups which continue to operate in different parts of the country. And the interplay of geography is another lever. We are not bothering with that. We are saying you maximize the opportunity, whichever geography is okay. We are not kind of controlling or holding back any geography on that.
Just one, larger perspective relating to what question you asked and what Ajoy shared. In 2007, we had sort of, in one of these meetings, we had spoken about between 2007 and 2012, we were gunning for about 10 percentage point increase in the share of studded and about 300 basis points increase in the EBIT of the business. And what actually happened in 2012 was that studded mix didn't change at all. From 30%, it remained 30%, but we achieved the 300 basis points improvement in the EBIT margin from 6 or something to 9 at that time. And that was because of the scale change that happened in that 5 years, and it was some 4 or 5x of sales. So therefore, even as we go forward, the share of studded is not a KPI that we are looking at all. We're looking at the sale of studded and the growth of studded. Now, because of a huge thrust that we are making in the wedding business, and the wedding business is substantially about gold, the share of studded may actually drop. But despite that, the profitability of the jewelry business of Titan Company can increase because of the leverage that the scale brings. Therefore, even in conversations on the quarter, when there is a question relating to studded share, we make this point, and I'm just taking this time extra to make this point, that the share of studded is not a KPI. The growth in studded at 20, 25, 30, whatever percent Ajoy and team, think should be done is of course a KPI, but that may be with a 40% kicker, sitting on the gold side simultaneously.
And just one more question. Sir, we as a team are known of, thinking much ahead in the future. So are we thinking on the lines of, say if metaverse comes or anything like that, that could help us reduce our inventory, because that can really change the game for us?
Yes, we are. We already made an initial step, but this calendar year itself, you will be able to see some very exciting plays from Titan in the metaverse. What we are looking to really do is to distinguish between fads and a persistent presence, which is engaging and eventually delightful. That's what we are working on internally. But do watch this space from us.
So it is possible over the years to bring down our inventory in a substantial manner. Am I right? If all that what we do.
Well, in parallel, we are also working with every business team on supply chain transformation and agility and optimization. I would think that would probably deliver better results on the inventory front than the metaverse by itself. Because finally, we are a physical products company, and the product has to be there at the point of experience and engagement and sale.
Okay.
I mean, if your question was from whether people will move to virtual and thus save inventory on that, I think that might happen more through tokenizing. It might not happen through NFT more so than anything else on that. But I think we're still far away. It's
what is tokenizing?
When you create an NFT, you create a token. So if you want to create virtual goods, you'd have to tokenize them.
Okay.
Like video games where people go and buy clothes, virtual clothes, they'll buy virtual jewelry. I can't imagine any other way that would come down.
Okay.
Yeah. So if people start, I don't want or need to buy jewelry anymore, I mean, physical jewelry anymore. So I'll buy an NFT jewelry and my avatar will wear that NFT jewelry, in which case there is no need for us to store that as a physical inventory. So if that happens, and there are some companies which already, I mean, I just saw recently, I think Gucci or Dior, starting, in fact, selling also $400,000 or something like that for an NFT bag. And Nike is already starting to do, NFT shoes and stuff like that. So when that happens, the need for physical inventory also, is not there. But as long as people want to wear real jewelry on their body, it's different.
Okay, thank you, sir.
Yeah, hi.
Hi, this is Richard. Here. So I've got two questions. One is if I refer back to to Ashok's slide on cruising and shipping one, yeah. And what I notice out there is that you've put that dark green shade against jewelry, but Carrot Lane actually had a light green shade, and even watches, which actually did quite muted in the last 5 years, that had a dark green shade, right? I mean, so basically watches and jewelry are both cruising and Carrot Lane was sailing. What is the context out here in which you're really measuring performance? Because I thought Carrot Lane did very, very well and, definitely much better than watches, or so it seems. So just wanted to understand the context behind that grading.
So there was a 3-4 dimension in selecting that. And of course, it's slightly subjective. But one is that not only growth rate, you have been consistently profitable for a long enough period and created a track record where, things are now, and then the investment aspect, that was the third, and all the, the team talent, everything. So you are right, Carrot Lane has been growing, but it just became profitable 2 years before, and this year a good profit, but still, the overall margin profile of EBIT, and they need to create a track record of 2-3 more years on growth as well as profitability to earn that, in my grade, the dark green badge. So that's what I would suggest.
Okay.
Thanks, Ashok.
Second question, just playing devil's advocate out here, right? And, you've talked about a lot of, thrust from COVID, and now COVID is over, and therefore there'll be a lot more tailwind that will come, right? I mean, I was wearing mask during the break, so somebody told me that that the country is not yet fully opened up, so there are a lot more opportunities that are yet to come by. So all those stuffs we are talking about. But if you look at it, there are also some stuffs where Titan company, especially the jewelry business, has actually benefited from COVID, right? And I remember Venkat, you talking about the gift size to the bride has become bigger because people are not having lavish receptions, etc. anymore. But now that all those are back, do you see some of these as headwinds here onwards? And also on the cost side, where there were probably a lot more savings that happened because of COVID, of people being locked in. What are some of these headwinds that could come by to the business because of the country opening up?
Yeah. On the face of it, all those advantages that we had in the last 2 years, some of them are already starting to turn, I think, because I've been desperately trying to get visa interviews to go abroad and not getting the slot. So clearly, more and more people, a lot of people are wanting to, go on holiday outside as well. And we saw that as a source of business for diamond jewelry and all that. But at the same time, what we've seen, Richard, is in the last 2 years, there has been a dramatic change in the manner in which people are viewing brands and trust. And everywhere, and we've been traveling into, big cities, small towns, everywhere. I think the desire to buy trusted brands, and particularly in the case of jewelry, Tata and Tanishq, that has also been dramatically increasing. So while some of these which helped us in the last 2 years are going to, sort of come down in their role in our lives, for example, the big fat Indian wedding, which didn't happen for a while, is going to start happening, but the trust side is one. And the new engines of growth that the division has sort of created ratcheted up, and they're now starting to, I mean, we're doing, I think the target is on 2,800 crores or something like that for Omni. 2,200 crores. So the new engines of growth are kicking in. So I think on some we may lose compared to FY 22 and 21, but on some we'll gain. And the overall opportunity in the jewelry industry is so large that we are not we are observing these changes, but we are not worried about, their role in sort of suppressing our growth ambition. Ajoy, anything?
Just I'll add to that. People have also saved up a lot of money over the last couple of years. And while some of that money will go into travel and hospitality, etc., that we are seeing across, whether it's airports or hotels, I think their investment or their spend in jewelry is not necessarily going to shrink because of the share of wallet. So on an absolute level, while on a percentage level, it may look like, oh, this has now come back and this has gone down. We saw even in jewelry, it was the relative share which remained. It is not that they suddenly expanded the amount of jewelry they were buying. It is just happens to be that they didn't cut down on spending on jewelry because it was also a stored asset value. So the percentage is one, but the absolute amount is likely to remain stable is our best estimate. And a lot of it depends on how consumers, if the sentiment continues to be positive, we shouldn't worry about it. Share of wallet will plus minus can happen. Not too much to worry.
And anything on the cost side?
So on the cost side, yes, fixed costs have come back. Rentals are back. We baked it into our business plans. It was understood it was interim. We had held back on marketing investments, during the COVID periods, and therefore you will see jumps. In fact, you all saw the jump even in Q4 results, or even in Q3, we had invested back. So the fixed costs are back. People costs are certainly there. And which is why I think Ashok has been also sharing that margins will be stable. All the gains out of operating leverage will not necessarily flow back because there are investments going on in fixed costs. Ashok, I don't know if you have anything.
All right, thank you very much.
Yes, Avnish.
Hi, sir. My name is Varun Singh from IDBI Capital. My question is on the eye care business. And it was a wonderful presentation wherein we talked in length about the abilities that we have created and we exist with as a company to drive growth in all the categories. But I'm sure we almost also agree that luck has equal, if not more, role to play more than abilities to drive the success in all the categories that we are hungry for. Yeah, so, and as a company, we were lucky enough to have ventured into jewelry business. From the simple trading of jewelry that we were doing to meet foreign currency demand. And in fact, we were more than lucky to have ventured or landed to a wonderful name like Tanishq, instead of choosing a name like Titan Jewelry. Of course, the way jewelry business was struggling earlier, and Xerxes had a tough time to convince the board that why watches business should not be funding the losses in jewelry. But, the luck along with the ability which has played a wonderful role in driving stupendous amount of success in the jewelry business. We see relatively absence of luck on the eye care side of the business. And of course, the way, every 10 years we ventured into a new business category. After watches, 10 years after we entered into jewelry, and then after 10 years we entered into eye care. And again, after 10 years, we entered into Taneria as a business. So in case of eye care business, of course, all the abilities that we have created, my concern is on two sides. One is on at the product level. We say that time is the toughest test to pass with regards to how the reality is catching up with the fantasies of our growth and ambitions that we exist. So more than 10 years of existence, and still, we are kind of flirting with some kind of operating profit. And of course, we are guiding for a good amount of growth in this category. But more than trying to fix the basic abilities related thing, for example, store size or the price points, etc. I find absence of popularity driven tailwind in this category for Titan I Plus. Also, I mean, the basic observation is when we go to the store, we see, you know, from 200 to 10,000 rupees price point, all Titan I Plus products. But I mean, there is absence of creation of the, you know, a different brand to address different categories. So is it the price point which is, you know, kind of competing with each other? So my basic question is how, more than the numbers or the data worshipping that we are doing right now, how are we thinking at the product brand strategy level to address the competition, sir?
Before Showman answers your question, I would like to give you two perspectives about some comments that you made. It would be a disservice to the memory of the founder of Titan Company to say that we got into jewelry by luck. You know, Mr. Desai's vision was to transform the jewelry industry like the way he transformed the watches industry. And the second thing is, it was not through luck that he got the name, identified the name Tanishq. Just some history, you know, in your interest. And now, Showman, if you can talk about the.
Yeah. So if I understand your question, you are saying at one level, we have taken a long time to wherever we have come. Maybe last 2 years have showed some progress. And we haven't done enough in the space of product for mass appeal. Is my understanding somewhat right?
Yes, that's correct.
Yeah. Okay, so what we have done in the past, we have done. What we are thinking of doing is that I told you the first shift is that earlier we were playing like every other business that we were in, more like lifestyle player. But we realized this business is in lifestyle, but a lot more than that. Like, for example, the day when you got to know that you have to wear a glass, I did not know, I don't know whether you felt particularly thrilled about wearing this piece. So in many of our understanding as well as research, we realize that people do think it is still a handicap. While given that this handicap is part of my life, I can make the best of what I can do. So that's one side of the story. Other side of the story is that a huge number of people are unaware, which I explained. So the way our business would grow and grow sustainably, profitably is to make sure that we serve a large part of the current population who are already using it, which is why we have created product ranges right from the economy range that I spoke, going all the way up to 10,000 or more, that is in the frame side. On the lens, you can get a 400 rupees lens. You can also get a 40,000 rupees from the brand Titan itself. Not to mention, we also have one or two other partner brands. And as you start using specs, okay, when your power is 1.25, that's one story. When you're 25-year-old, that is another story. When you become 35, when you become 45, when power actually starts growing, etc., your expectation from the category significantly changes. I can only talk about myself that, you know, I was wearing glasses from the standard 7. Okay. I tried many ways of getting rid of this. Sometimes it was giving me a good feeling. Okay, I'm the studious boy, whatever impression you have to create. On the other side, on the football ground, I broke my glasses a few times. So at one point of time, I actually gave up. But later came a day. Okay, let's talk about today. I can forget everything else when I step out of my house, but I can't forget my glass today. That became the level of this, you know, the dependence. So what happens is in this category, when you get into it, it's quite likely that it's going to be your lifetime requirement. Very few cases of reversal really happens. So therefore, whether in terms of product that we are creating, the price point that we are addressing, the access that we are creating across the smaller big towns, even in a big town, multiple catchment, etc., gives us reasonable confidence. Also, what we have managed to do in the last 2 years of the most unprecedented disruption that as a human race we've come across, that if you could do this, we can certainly grow far more rapidly. And also, we are not burning someone else's money. Okay, we are not playing any valuation game. We are in the value creation game. So all put together, This conversation is on for some time. If we needed another 5,000 or 10,000 or 20,000 crore, I don't think we would have ever got into this category. There is a far larger motivation brought us into this category. We are going to fulfill that part of the destiny. And as you would see, I don't want to make a forecast, but as you would see, as we have already fixed a few things, and there are many things that we are going to do, that would give us both scale as well as the reason for people to stay interested in our business. That's broadly what I have in mind. If there are some little more specific areas that you want to sort of talk about products, etc., maybe we can take your direct inputs to address.
Right. So just wanted to know that if you have a strategy like catering to mass popular or premium brand with a different brand name product under the brand Titan I+, or we wish to sell all the brand under Titan name in all the categories.
See, Titan I+ is the retail format.
Yes.
In that, Titan range of products are there, that is frames as well as lenses. In the frame, there are 3 sub brands of Titan. Ace, which is below 1,000 rupees. Crest, which is about below 3,000 rupees, 1,000 to 3,000 rupees. Above 3,500 rupees, where move around to what's called signature range. There are 3 sub-segments within the Titan brand itself. Then we have Fast Track range, which is in the youth space, starts around 699, 700 rupees, going all the way up to 2,500 and so. Then you have a Dash range, which is for kids. So that's the way it is, currently distributed. But we haven't started playing with the sub-brands yet in the public eye.
Understood. And so just last question on what are we in eye care and eyewear business? It will be better that if we drive a communication with regards to what we have solved for or what customers is getting much different compared to going to other eyewear places. The reason I'm saying this is the popularity. Of course, we say that in today's time is a more lethal tool to wield power over customers compared to advertisements that we are doing to make aware about the existence of our products. And we see that, this popularity having created tremendous amount of wealth for so many players. And in case of Titan I+, I find the relative effort towards creating this extremely clear-cut communication with regards to what we have done. And of course, we have done a lot of good things that will be very helpful.
Sure.
In the interest of being fair to a few others because we have time only for 2 or 3 more questions.
Thank you very much.
Yeah.
Hi, sir.
Thank you.
Abneesh here. I've got 2 quick questions. First is on the tier 4 data, which you shared, Henkanel, Angul, 50% market share, 50 crore kind of number. What is driving this? Is it sporadic or many states are giving you this kind of number? Is it because of your ability to spot these kind of cities much ahead of competition? And are you gaining because of all this regulatory change of hallmark? And that's why Tata Tanishq brand is really helping in this kind of a small city?
One of the things I have personally seen in actually all the 3 names that I said, and I've been to Eluru, Angul, Baleshwar myself. Actually, these stores of Tanishq, or even in the case of the World of Titan or I+, they are unbelievable in that town. You just can't imagine a retail store of that size, that prominence, that luxury in such a town. So it's like a huge tourist attraction to begin with. And in a category like jewelry, which is so deeply penetrated and where the competitive references are so far away, I think it simply attracts people to that. And because we are going with partners who are big, people in that town, in that catchment, their connections to high net worth is also high. And therefore, it's somewhat like, what I briefly said about the US, where the competitive situation is so much to the advantage of Tanishq, because all these big players are not present in the US. When we go to a Baleshwar or a Jajpur or a Kuch Bihar, we are somewhere else compared to the local jeweler. So it dramatically changes the equation in our favor. And all the differences, that 4% making charge point that, he had made, but the real difference in value because of the purity, the service, the design quality, the store experience come alive, and we just take over the town in terms of market share. That's what I'm sensing. The retailing, overall brand retailing combination, that customer value proposition combination is the biggest, difference. Abneesh.
Sure. Thanks. My last question is on CaratLane and three subparts to that. So first is, could you talk about your average transaction size per customer, some trend last 4-5 years, and similarly average selling price per jewelry, if you can share some trend. I'm not asking for some exact number. And 5 years down the line, how do you see? Because you're working on affordability. Second is, some of your unlisted competitors are raising funds. So how is your positioning and competitive intensity, how is it shaping up? And last part, cost of business, is it going up from a digital advertising cost perspective? Because there is clearly much more privacy laws coming, both Facebook, Google, and even Instagram. I think clearly cost is going up. Do you see that as an advantage or as a cost challenge?
The three of them, let me get them one by one. On ASP, or average selling price that you spoke about, we have, this year it came down by about 5%. I'm going to speak in index numbers rather than absolutes. It came down by actions that we're taking. We're averse to taking the ASP higher. We don't enjoy that. It could, in the range of 10% plus or minus because of our input costs and things like that. I think it's our job to defend it and try and bring it down, because wallets don't expand at the rate at which gold prices go up. And so we have to solve for that. And that's a job of the business. So that's where we are with that. Basket sizes are 1.3 to 1.4. That's where we work with that. Sorry, the next question was, competition, and raising capital. I mean, I have the best balance sheet in the business with me, so I don't know whether I worry about that. It's not something I worry about. The last bit is, 200 crores or 300 crores of fundraise cannot give you the trust that you get from Tatas. So I don't think it's something for anybody to worry about. It was a key decision in CaratLane getting acquired. And I don't think that situation has changed even with this today as well also. The fact is that the market is expanding at that point. And I think everybody is seeing that. And if you look at Titan itself, having CaratLane and Mia is best positioned at that spot as well. We will get sharper and sharper with our definition of these brands. It's a matter of time. It's a company that builds over consensus. So I think best positioned to solve for that problem. And there's also Diamond Treats and Tanishq. Between us, we will have sufficient choice. And as Ajoy spoke about earlier, as one of our independent directors pushes us, why not have a 100% solution for it? I think that's where we'll end up with that. The last bit on digital, yes, inflationary for sure. But if you think about intent, if intent improves greater than inflation, cost of digital will never be a problem. And we need to work to solve better at that. And we've seen it go down over the last 3 years rather than go up. So cost does go up, but intent goes up greater. And thus the net result is that we deliver better than what was the expected cost. The challenge is going to be with Apple and what privacy policies they come up with. And then the rest of the market follows that. But, like most things in life, there is a challenge and then there is a solution, and that's how it will play out.
I'll just add one bit to that. I know CaratLane has done it very well, and now Tanishq is also doing the use of the app, which in turn means that you have a certain minimum number of users who are always receiving information from you, and that has been a big one. And I think that CaratLane has driven it very well, and now we have close to 4.5 lakh app users in Tanishq as well.
Yeah.
One last question, please.
80% of people on repeat come and buy through the app in CaratLane, just for you to get a sense. So that draws costs down a lot.
Hi, this is Avi here from Macquarie. It seems in the jewelry business, your focus is on getting a lot more new customers at the top of the funnel. And during one of the answers, you mentioned that you've moved the gold price differential towards the making charge. If you could explain what drove that change, because it seems that they would be in they would contravene each other, or is there a read-through on the way the customer thought process in buying gold jewelry has changed? That was the first question. The second that I wanted to ask was essentially on the agility part. If you could give us some numbers in terms of the timeline, how it has changed between the concept to actual delivery of the product, and whether that where it has changed over the last 5 years, and where do you expect it to go given, the regionalization? Maybe those products are relatively simple to make. Is that any sense on that, please?
Yeah, so on the first part, which is to do with gold rate, and it is not that, it is the way we are managing the business that I summarized it and said. It is not that like to like we've taken a making charge increase. It is managing the product mix in the store and in the market in a certain manner that you deliver a certain overall higher making charge. Yeah. And the gold rate part is also impacted not just because of competitor moves, but also because the gold price has gone up. And therefore, people also are a little hesitant to invest. So we spent a lot of effort in coming out with lightweight jewelry. In fact, a very large chunk of our daily wear products have been converted into lower, let's say lower grammage, but the customer is comfortable paying a slightly higher premium on the making charge because the overall price, a little bit what Mithun also referred to, has come under a certain budget. So it's a combination of events. It is not that there is a trade-off between the customer saying I'm paying gold or I'm paying making charge. The customer is not doing it. Second piece what was the second part?
The second bit was the agility.
So agility is in the way we have combined between sales, retail, merchandising, marketing, and supply chain to respond to a situation, not so much try to reduce the lead time of the new concept. So that has more or less remained there. You're right, for some of the regional products, the development times are much faster because you don't need to design from scratch, and therefore it's much faster to introduce. It's the collaboration and the simultaneous collaborative response that we're able to give on a week-to-week or a month-to-month basis to a market.
And just one last, if I may try, could you give any guidance on FY23 sales growth or margins? This is something that you've historically shared, but
I'm giving it to the right person with the mic.
This we will close the Q&A session. So thank you very much, guys, for coming in good numbers and being with us today. There is a lunch waiting for you outside, and we are available at that point of time to kind of do this.